This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Eric, it's great to have Tian back on the show. Now let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Tian's picture saying, looking for the downloads. Okay, Eric, let's get into these charts. What are your thoughts here on equities?
Well, Patrick, I think what's going on here is exactly what I've been warning about since the election. The market was acting as if Trump was somehow magically just going to succeed without any resistance at all of his policy goals. Trump has been clear all along in saying that protecting equity markets was not going to be a priority of his administration. But it felt like everybody just thought he was bluffing or something. Our friend Isabella Kaminska penned a piece on The Blind Spot pointing out that the Trump administration has been signaling all along that we should expect this market rout. And that piece was published on Saturday, 2 days before Monday's market slaughter. Now, finally, everyone seems to be getting the message. Trump's policies are huge, and so are the risks of policy blowback. A breakdown of the U.S.-Western Europe alliance that's been in place since the end of World War II could be at stake here. These are times of big change, really big change, and therefore market volatility was a clear, certain, and obvious outcome from the beginning. Only now does the market seem to be waking up to all of this. After Monday's market slaughter on the S&P, I think the logical thing to expect next would be a relief rally back up to the 200-day moving average, which is right around 5780 or so, 5780. But from there, I think another leg lower is still entirely possible. But so is a V-shaped recovery from here. My real point is what happens next will depend on news flow. And the only thing that we can predict with any certainty is volatility. The range of possibility here is so wide that it goes from Trump getting assassinated in his first months in office all the way to Trump succeeding in all of his policy goals and having them all be effective. And there's obviously a huge number of alternative scenarios between those two extremes. Nobody can possibly predict the outcome of these things until it happens. So as far as I'm concerned, the only prescription that can be made with any confidence for this market is to put your seatbelt on and get ready for an exciting ride.
There are definitely a number of alternative scenarios of the two extremes of how things can play out. But let's just take a moment and look at this purely from a technical perspective. We had basically a 6-month topping formation in the markets. And finally, we saw a break that has now led to a pretty methodically straight line decline of 10% in the S&P 500. And so we're now at a really interesting moment because the markets are quite oversold. And whenever this type of a magnitude of a market correction typically would happen, if it's in the midst of a bull market, this would be often where the buy on dip would come in. You would see short-term lows. There's certain extreme readings on the markets from very oversold conditions, and usually this is where things turn. But now let's go with the alternate scenario that this is the beginning of a much more prolonged bear market. It doesn't have to be a severe financial crisis or anything, but just even in a scenario like 2022 where the market simply had to mean revert and spent half a year to a year consolidating off of its highs. If it's one of those scenarios, then usually you see a market drop of 10 to as much as 20% in the first wave down. And after that comes a pretty violent market rally that swings the other way, but does not approach previous highs by any means. And so this is really a really important moment in the markets to determine which of these paths the market is taking. If this is a big buy on dip, then we should see the buy on dip traders, even within the next 1 week, somewhere emerge and start some sort of a meaningful rally back towards 5,900 in a rapid fashion. But if in this very weak distributive state of the markets where we're so oversold, if it just leads to more and more selling, a 15 to 20% correction could see us down to as low as 5,300 to even 5,000 on the downside. And that is the puzzle to solve as to whether that kind of a bigger sell-off is occurring. Now, to kind of add to that, on page 3, we have the Magnificent Seven, and you can see the Mag 7s broke a very key bullish trend line, have been decisively below their 50-day moving averages, and have been the center of almost all major distribution. Will we be able to see the Mag 7s meaningfully reverse and bounce along with the S&P 500 is going to be an important clue, because the Mag 7s are such a huge market cap weighting that it'll be very difficult for the S&P to make it back to 52-week highs without the Mag 7s turning at the same time. And when we look at it from a volatility perspective on page 4, you can see that the VIX has spiked up to a 28 level. We've seen that twice in the last year, once in August and once in December, where we had these spikes. But there's a very big difference, because volatility rose to this 28 level in an incredibly methodical fashion. Both times in August and December, when we had big spikes, they came on one-day market scares and massively reverted within days. And so this is a slightly different field to what is happening with volatility. And it'll be very interesting to see if volatility stays up in this 20 handle on a sustained basis, which would be further evidence that this market has shifted in its personality and its nature. Other interesting notes is that we've seen credit spreads and junk bonds finally starting to spike. We're seeing junk bonds breaking down, and when markets enter usually deeper market corrections, usually it's accompanied by some form of credit correction as well, and that is starting to emerge as well. So to sum this all up, a market bounce can definitely happen here, but this was definitely a market environment where the hedges that we've talked about many times in the past on this show have worked so well in this environment, and certainly a good time to remain hedged as this moment of uncertainty is coming.
Patrick, obviously those of us who didn't heed your advice to hedge downside risk back in February paid a price for that. But hindsight's always 20/20. So now that we've already tested a full 10% correction level from the peak on the S&P, the question on my mind is, what hedging strategies are left that can be applied now after the fact for those of us who failed to hedge the risk of this correction before it began?
Well, Eric, you can still apply the debit spread hedging strategies we are actively using at Big Picture Trading, because they are more volatility neutral with favorable skews. But what I wanted to focus on now is on how to repair trades that have gone against you, because at some point you will come to a typical short squeeze move where many of these stocks will reflexively retrace some of the recent declines. So let's talk trade repair. So if you've ever bought a stock only to watch it sink 20, 30, even 40%, and then you're stuck thinking, do I take the loss or throw more money at it and hope? Well, you're not alone if you have. We've all been there. And today I wanted to share something that most investors don't even know exists, a way to repair a losing stock position without adding more capital. You see, most investors think their only option is to dollar cost average, buying more shares at a lower price to average down. But that approach has real risks. You're doubling your exposure to a trade that is already hurting you, and you're tying up capital that could have otherwise been used for better opportunities. And the worst of all, you're doing this without a clear exit plan, just hoping the stock comes back. And let's be honest, hope isn't a strategy. Instead, what if you could attempt to fix the trade, lower your break even dramatically, but without adding a dime of new money? And that's where options repair strategies come in. Now, there are a few different ways to approach this, but today I wanted to focus on one of the simplest and most effective, the ratio call spread. Now, I love this strategy because it often requires no additional capital or most a tiny amount, and it gives you a real shot at cutting your losses or even breaking even on the stock when it rebounds. Let me give you an example. Now, I'll keep it simple with round numbers. Imagine you bought a stock at $100 and it's now fallen to $80, so you're down 20%. And now to get back to break even, the stock would need to rally 25% all the way back to $100. And that feels like a long way up. Instead of buying more shares, here's what you can do. Step one, you buy a 1 month $80 call option. That might cost you about $4 in this example. Now, step two is you sell two $90 strike call options, $10 above where the current stock price is trading, and let's say you collect $2 for each. Since you sold two calls for a total of $4 and bought one call for $4, the trade nets out to zero cost. And since you already own the stock, both calls are covered. Now, what happens if the stock makes even a partial comeback? Let's say it rallies from $80 to $90. In that case, you've recovered all of your loss by expiration. Instead of needing a rally back to $100, you're exiting near break even at 90 on a trade that was badly underwater. At the same time, if you were early on that repair strategy and the stock proceeded to continue to decline, you didn't dollar cost average and you're not losing on twice as many shares. The option spread just expires worthless and you get to try it again. Now look, we've all been in those losing trades, especially in markets like this where volatility is high and things feel unpredictable. But strategies like this give you the options, real options, to fight back and manage the trade. Just imagine cutting your break even dramatically without adding more capital and without throwing good money after bad. And right now, with the markets as oversold and volatile as they are, I think it's critical for investors to understand how to apply these kinds of strategies because these situations are everywhere.
Patrick, for our listeners who want to delve into these repair strategies in more detail, I understand you're working on a webinar on that very subject. When will that webinar occur? Is it free for MacroVoices listeners? And where can people register for it?
Now, obviously, there are more details to doing this right, like how to pick the strikes, what expirations to choose, what to watch for, and that's why I'm hosting a free live webinar on option repair strategies. And I'll be walking through the exact mechanics, sharing real-life case studies, and showing you how to avoid common mistakes that trip people up. If you're sitting on a losing position right now, or you just want to know how to handle it when it happens, this is something you don't want to miss. It's happening on Tuesday, March 18th at 4 p.m. Eastern Time, and you can register for free at bigpicturetrading.com, or the link is in our MacroVoices Research Roundup email. All right, Eric, let's get back to the charts and let's talk about the dollar.
Well, Patrick, 104 has been a key level on the Dixie for years now, so taking it out decisively to the downside this week was an important signal. As the situation appears now, I think lower numbers are still in store, but we've come an awfully way down already, so a bounce higher to repair the TPO chart would make a lot of sense before we eventually see lower numbers. But again, my strongest overall caveat about this whole market is that this action in the dollar is a result of news flow, policy decisions from the Trump administration, and they're changing by the minute. So a big move in either direction is always possible on changing news flow.
Well, Eric, when looking at the dollar, that breakdown that happened over the last 2 weeks has done some serious technical damage. Even 2-3 weeks ago, when we were sitting still in the 106, 107 range on the upside, there was an easy technical argument to make that there was just a consolidation for a bull continuation pattern. But with this deep of a drop in the US dollar index, it has done some real technical damage that at minimum neutralizes the last bull cycle. Now, does that mean that the downside floodgate is opened and there's just going to be a collapse of the dollar? Probably not. But at this moment, we haven't seen even an attempt to bounce it from such an extremely oversold scenario. This could mean that we're going to re-enter that 2-year trade range that was bound with 100 as the lower level and 105 as the upper range. So could we see some weakness of a few more dollar index handles to the downside to retest some of the lows of the last 2 years? It's plausible, as the dollar really has lost almost all of its upside momentum. All right, Eric, let's touch on oil.
Well, we've entered a consolidation range with the floor right on the 52-week lows, around 65.20 on WTI, and we're oscillating up and down maybe $3.50 above that level. My read on this is what we're doing here is fighting the 52-week lows, which are acting as a strong support. I think the market's trying to test to see whether we can break lower below that number from here. I think we probably will, and if we do, I wouldn't be surprised if that accelerates the selling down into at least the low 60s. One message is clear. President Trump wants lower oil prices, and so far, quite frankly, he's been willing to play hardball in order to get what he wants. Ultimately, oil prices significantly lower than they already are only going to hurt American shale producers. So if we get a breakdown below this support level, I think it will probably be fairly short-lived and therefore a buying opportunity. I also have a suspicion that President Trump's plan may be to try and push oil prices as low as he can possibly get them for the sake of taking a victory lap on the public stage for doing something that Biden failed at, but then to immediately commence a very aggressive initiative to fill the Strategic Petroleum Reserve back up to the rim with every possible drop of oil that will fit. In other words, pull oil prices down, take political credit for doing that, and then put oil prices back up, but do it in a way which services his Make America Great Again agenda by filling up the SPR, something he said that he wants to do. That would support prices, help American producers, and if he does it after at least allowing prices to stay, let's say, for a few weeks down at a lower level, doing something that Biden was not able to do during his term in office, well, that buys him a bunch of brownie points with the American people. That's pure speculation on my part. I have no idea if that's going to happen. I'm simply suggesting that it would make sense and be consistent with what President Trump has said for him to try to do something like that, and I think he has enough levers to pull in order to make that happen.
Well, just technically speaking here, Eric, we came for a direct technical retest of the September 2024 low. And we have at least seen some short-term bullish reactions off of that low. But is it a new bull phase just that because we tested a support line? It's a little premature to jump to that conclusion. We could easily bounce towards $69 and $70 on the upside just from the reflexivity of the magnitude of the prior decline. And that in itself wouldn't even do any technical bull signaling like oil's ready to run on the upside. At this moment, we have to respect the prevailing downtrend. We also, though, have to respect the big support line. It's more likely that we have to anticipate that the remainder of March is going to be a period where oil is going to have to establish some sort of a basing formation from which the bulls can potentially lean on if they're going to turn it off of these levels. Though, Eric, I wanted to touch on page 7 where I have the 12-month natural gas fund, which is essentially trading a natural gas strip and removing the seasonality of natural gas futures. And what we have seen is an extraordinary bull advance in natural gas prices as we've gone off of, on this chart anyway, from the $7 level up to over 30+% towards the $10+ level on the upside. We have now exceeded all the levels that we traded at in 2024. It's one of the few charts that continues to look actually extraordinarily bullish. Now, there is a very big overhead resistance in the $11 to $12 area, so it's not exactly like there's a big asymmetric opportunity to start buying up here, but there's a definitive bull trend, and I think that buying dips on natural gas is something that may continue to work. All right, Eric, let's touch on gold.
As I mentioned on last week's podcast, what we're seeing is a new wave higher, already above last week's highs, and there's room to get to about 30.12 or so on the April contract before hitting the channel resistance line that contained the market on the last swing higher. But the weekly chart is still overbought. So while we might hit that round number of 3,000 or maybe 30.10 on this swing, I don't think we can move materially higher, 3,500 or something like that, until the market has time to consolidate first on a sideways trading action or even a down move for a few months in order to shake off this extreme overbought condition on the longer time frame technicals. The exception to that, of course, would be if the Mar-a-Lago Accord really happened or if there's a formal revaluation of U.S. gold reserves. That could bring a breakout that just defies all overbought technical levels and just takes us much higher. So anything's possible, but barring a really big news event to support it, feels to me like this market maybe has one more swing higher, test that round number resistance at 3,000, and I think it's going to run out of steam, at least until it has time to consolidate for a few weeks to a few months.
Well, Eric, I just want to highlight that from a perspective of gold, I remain very bullish. It's a primary bull trend, higher highs, higher lows, all support lines keep holding. The debate for me, though, is gold going to just break out here in March to an all-time new high and punch to like 32 or 3,300 on the upside, or are we in the midst of a prolonged consolidation? I want to highlight that, for instance, back in March and April, when we had a big push in gold from the 2,000 level up to about 2,400, gold ended up spending 3 months trading sideways along its 2,400 highs before ultimately breaking out again to continue the bull run. And so for me, this still has vulnerability of still being in this consolidation phase. And just because we're retesting the high right now is not convincing enough for me that right now is when the next bull continuation pattern happens. Now, for me, I could see a consolidation that potentially still maybe even during a broader market liquidity event could test 2,800 on the downside. And it really could be a second quarter of the year story when gold gets going. But if we do finally see a meaningful and sustained breakout of gold, then a move up towards 32 to 3,300 is definitely the upper target in this bullish chart. All right, Eric, let's touch on uranium.
Well, this was another week of even lower lows on an already oversold uranium market, but I'm finally seeing signs of improving technicals. Specifically, a few weeks ago, we had the uranium sector selling off hard even as the S&P was holding up along its all-time highs. But even during Monday's market carnage on the S&P, a few uranium sector issues were actually up on the day, while others were down, but not down nearly as hard as the S&P was. These signals give me confidence that the uranium sector is ready to find a bottom and reverse its trend to the upside just as soon as the broader stock market is ready to recover. But as we discussed earlier, it might be a while before that happens, and much lower numbers could be in store before the broader market bottoms, and that will be decided by news flow that we can't possibly predict. Now, barring anything other than an outright, stock market crash 40% down or something like that, I don't think we're going to see that much more carnage on uranium, because I think the uranium capitulation has already played out, whereas the broader market S&P capitulation, if there's going to be one, hasn't really happened yet. So I don't expect to see uranium continue to underperform the S&P, but hey, if the S&P continues to move lower, and especially if it moves substantially lower, it's definitely going to bring new lower lows on uranium. Still buying opportunities as far as I'm concerned. I have no idea how long it's going to take for this to shake out, but eventually this uranium market has to turn around. They've got to buy fuel for all these new reactors that everybody wants to build. It's coming sooner or later, and only time will tell.
Technically, Eric, uranium continues to be in a distributive cycle lower highs, lower lows. It hasn't yet seen new accumulation and or new buying, and this is where I would want to see some sort of price action stability start to form in order to speculate that a bottom is in. Overall, I think that this will prove to be a good price level for the long term, but on the short term, it may be a very quiet and boring holding period, waiting for uranium to come back to life again. And the final thing I wanted to touch on, Eric, on page 10 is the copper chart. And surprisingly, Dr. Copper continues to plug away on the upside as it's making higher highs and higher lows. And now only real resistance above is its previous highs from May of last year, which were up in the 5 to 510 area. Copper, like natural gas, is in some sort of a new accumulation cycle and continues to work.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.